Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Surbi Upadhyay, Pavitra Parekh, and the man standing with us is Prashant Nair. And Surbi, what next, right? That was the big question that you had yesterday when we started Trading Hour, and you've got that what next. It's all about the debt capital markets. But just a quick word on the Nifty, currently a bit subdued, down 0.3% on the benchmark indices. Mid-caps are underperforming, mid-cap index down over 1%. The advanced decline ratio quite in favor of the losing side. We've got about 900 stocks in the green for about 1,800, 1,900 stocks currently in the red. Metals are down. The Nifty Metal Index down 1.7%, while IT is holding for today, so reversing some of the earlier underperformance. The Nifty IT Index is up close to about 0.7%. But this is not the story, guys. The story is all what's happening in the bond markets, debt mutual funds, indexation, no indexation.
So the story is actually, if you pull back, snap back, Reema, the story is even wider than that. It is just that every time you have amendments moved to the finance bill, you expect that, it's stuff that's largely been discussed, like insurance, for instance. There's been a lot of lobbying about raising that tax cap from 5 lakhs, right? But what we got last night, and I think Prashant had a busy evening, so did I, we had a very hectic morning, is that out of nowhere, out of syllabus, came this whole chatter about basically looking at a new regime for taxation for any mutual fund that holds less than 35% equity. That's the crux of the matter. Now, because of this definition, the entire gamut of debt mutual funds comes into question. You have fund of funds, global funds, gold funds for that matter. And that's really what we are talking about. And a lot of this is playing out on the asset manager stocks. So while it's not such a huge story for the listed equity space because there's no change in tax regime over there, for the listed asset management stocks, we are seeing that pressure play out. And the question really here is that will now debt mutual funds and gold funds and these fund of funds which invest in overseas equities, whether they will now lose the benefit of taxation, whether the indexation benefit goes away. And that's been one big talking point. By the way, the trade there was also, does it offer a quick incentive for people to cover their shorts in banking? Though this is, of course, this is only one development. But is it going to be enough for people to pull back on those heavy short positions? The Bank Nifty has kind of reduced its losses to an extent. It's still marginally negative, but that's something that we're talking out for. Is mutual funds loss banks gain with respect to money moving from debt mutual funds to bank deposits? That's the crux of this debate that we will address, and Prashant is here to do that. And Pavitra, of course, you've been speaking to a lot of people from the industry. Yeah. I think it's a pretty hectic, busy Friday morning for most.
It is, and we have, like you said, speaking to experts through the morning, and everybody agrees that this has just come as a huge blow to the entire debt category of funds. The fact is that, the indexation benefit was one of the key drivers for investments into debt, into gold, into, international investing as well. So when that's taken away, in addition, you also are being charged at the marginal rate, which is the slab rate. So how does that really impact flows into this category? Where does money move now? We have an entire panel joining us to take questions on this. So with us now, we have AMFI Chairman A. Balasubramanian, DP Singh, Deputy Managing Director and Chief Business Officer of SBI Mutual Fund, as well as Feroze Azeez, Deputy CEO of Anand Rathi Wealth. Gentlemen, good morning. Thanks a lot for joining us. Mr. Singh, I want to come to you first. Your initial thoughts on what has come through here, because the indexation benefit has been taken away over here from the debt category. They are now being charged at the marginal rate, which is the slab rate. How much of an impact are you sort of accounting on the basis of this amendment that's been proposed?
See, actually, it's very, very big disruption in our business. See, the kind of narratives which were being given every now and then, that narrative is gone. But at the same time, when I look at the overall numbers, the category in which, especially I'm talking about the debt fund, as I'm not talking about the gold and international funds as of now, around 35% of the debt categories in this category. It's still 65% in the category where people are putting in money for other reasons, for ease of business, for the short term, that is not impacted at all. And when there are disruptions, there are opportunities as well. I think overall ecosystem will get disturbed because especially to the NBFC side, if there's no supply. Today, the spreads between NBFC and other were very, very small, but now the spreads we feel will go up. And see, the yields of these debt funds will also
Mr.
go
Singh,
up. Yeah.
Good morning, all of you. Mr. Singh, if you can give us some numbers, what is the debt AUM? We should look at this liquid funds, right?
Yeah, ex-liquid fund is around 4.5 lakh crores. Almost
What is
4 lakh crores, 4 to 4.5 lakh crores. So that's my that number. And in addition to that, around 1.5 lakh crores, you can say around 6 lakh crores.
6 lakh
the
crores?
target maturity fund was not, in the overall numbers.
So 4 lakh is ex-liquid funds.
Ex-liquid plus target maturity, that was not added into this. The FMPs and target maturity, if we add that, it comes to around 6 lakh crores.
What is the yield that you made on this? It would be true for the industry as well if you can tell us, Mr. Singh.
It
is going far lower than equity, I'm assuming.
Yeah, it will be far lower than equities, but it has to be debt mutual fund has to be seen differently because indexation was one of the biggest benefit. But if the yields are good, especially the new categories which are emerging like target maturity funds.
Mr. Singh, I'm talking about earnings, what you made from managing this pool of AUM.
Yeah, earnings, I think weighted average earning would be around 30 to 40 basis point overall TER. And earnings were around 10 to 15 basis points put together.
Okay, 10 to 15 basis points on the debt portfolio that as an asset manager that you manage. Got that, Mr. Singh. Let me, get in Bala into the conversation. Bala, I think what really is being debated, and by the way, we had Mr. Khara of SBI with us just earlier in the morning. I'm simply quoting his argument. He said, look at these as individual products. Tax can't be the only reason that you pick one over the other. And I think that's a very solid argument from a banker's point of view. Bala, what would your thoughts be? Was it really the fact that it was indexation that was adding that additional yield and making a lot of these debt funds, particularly target maturity funds, so popular? Do you see a complete sort of move away from this category if they are going to be taxed at par with fixed deposits?
I think while one can argue the purpose for which they are brought in, clearly I think one has to understand the role that is being played by the debt funds for a period of time for the development of the bond market and better price discovery and making money available from the mutual fund by channelizing the retail and HNIs and institutional money to provide the alternate source of financing for banks, NBFCs and corporates, the form of lending. And in fact, the mutual fund have played a bigger role in this phase. Second is comparing this with the fixed deposit and other things. While indexation is a benefit, it gives an additional benefit to the investor in the form of return. I think the larger purpose that it caters to the market, in addition to the development of the market, is when the price discovery mechanism have become more efficient because of the larger participation coming from the mutual funds over a period of time. And mark to market. There's a mark to market, therefore nobody of course gets any return which is a linear kind of return or guaranteed kind of return, unlike FDs. But definitely it helps over a period of time generate the return on the base of the investment that is being made across credit maturities, across credit profiles, across maturities. So therefore, first and foremost, it came as a surprise given the fact nothing was part of the budget discussion. You yourself mentioned it came as a surprise, and even for us it was a surprise. Therefore, they are still as an industry making a representation, understand the importance of these industries playing a role in the capital market. Therefore, the fixed income asset class to develop. And we should not actually segregate between the listed versus unlisted. The fact of the matter is, I think debt mutual funds play a very key role in development of the capital market. Therefore, that needs to be understood. Second, from the point of view of the growing, I think as the interest rates are high, even today, if we compare US, I think the entire US industries, the bond market is one of the largest. And especially in the last few years, the money market funds have also been growing quite significantly, given the fact that most of the banks in the US have not been passing on the increase in rates to the investors by way of increasing deposit rates. Therefore, most of the people went to the money market fund, but that reflects the true earning that comes in the market.
Bala, let me ask you this, and I think you raise a pretty important point, which is at the back of my mind as well. Do help us understand. I'm not sure if some of the far deeper, larger markets, let's say the US, any of these developed markets, whether they incentivize debt funds by way of taxation. I don't know if that happens. Please do tell us. And you have the pulse on the investor. The critical question is, come April 1, if this is the new regime that comes in, come 1st April, do you see investors shying away from debt funds because they don't have the benefit to stay locked in for 3 years?
Yeah, I think, see, I'm not very sure about what is the taxation that's applicable in the developed market like US, but I'm only assuming that the very fact that the large pool of money is being managed in the mutual fund market, I would assume Indian debt funds and fixed income will continue to play a larger role. There's absolutely no doubt on that. But coming from the 1st April, given the fact that capital gain tax now, assuming scenario, it now has become a reality, then naturally one has to look at alternate space within the mutual fund space. That funds which has got greater than 30% exposure to equity would potentially become, as a result of that, hybrid funds would become the way of the mutual fund. That could definitely come. And again, from the longer term point of view, with both being equal and with the liquidity consideration being there, and also the high level of transparency that is there, and then capture the mark-to-market gain in case interest rates move downward, say let us assume about 1.5 years time frame, and anybody who actually buys the long-term bonds, it gets a capital gain when the interest rates turn negative. Such kind of investors will definitely still be coming in, keeping in mind the overall interest that they may have. But the fact of the matter is, as it stands today, what is one of the key objectives of our nation is actually to create a vibrant corporate bond market as equal as equity. Therefore, it's important actually for that segment to have the right recognition. And therefore, this taxation was never under the consideration from the removal point of view. Therefore, we'll make enough representation to make government also understands that how important actually for both for the capital market point of view, as well as a large portion of the proportion of investors' money should also come in the fixed income, given the fact it gives a right hedge between equity from an overall portfolio perspective.
That point is taken, Bala. Feroze, just weigh in, right, on the alternate investment options now for a retail investor 1st of April. You've got the debt mutual funds, but without any tax benefit. You've got corporate FDs, you've got bank deposits, and perhaps even hybrid funds now. Could you weigh in on the pros and cons of each of these investment options from a retail point of view?
So Rima, I personally think they're not all at parity even today. After this change, after 1st April, right? When you speak of income comes under 5 heads, right? Capital gain head is the most attractive head, in my opinion, out of the total 5 heads of income tax. Point 1. Point 2, if I'm going to get short-term capital gain, I would still not buy a bond directly. I would not buy an FD because I'm getting Section 73. I'm getting Section 73, subsection 3 to set off against some losses I will have. A portfolio will have equity, debt. Equity sometimes throw up losses. I can use those losses for the subsequent 8 years. And every year, equity markets move up 15% up and down. So they throw up losses for you to set off. So firstly, even if this were to be implemented, currently it's at the proposal stage. Even if it is implemented, I would never buy an FD if you have to rationally do it, because capital gain head is the most attractive head. And then you get deferral. If I invest today and don't redeem my debt fund for 10 years, I don't pay tax on accrual for 10 big years. And that itself, effective tax rate will come down. And the last point, Rima, investment taxation is never at a product level. It is at a file level. Let's assume one of my colleagues actually has a child who's a major child. So he gifted 2 crores to his daughter and then invested debt in that. No clubbing provision is applicable. Even a portfolio with 10 crores will get away with 5 crores in debt fund. Also with 2 files can get away paying 8% tax, even if this is applicable. So people have to do more work, have to do more mind application when it comes to taxation, is what this means. She has not categorized, madam has not categorized this as interest income. She's categorized it as capital gain. So people should not see the dark silver lining in the dark cloud. And I still would any day prefer a short-term capital gain as against interest income.
Right. Feroze, within equity, would balanced advantage schemes be, would you expect them to really gain prominence? Because it kind of gives you some downside protection, which is the idea with debt, some safety, and the upside for equity as well. Actually, and returns over a slightly 10, 12-year period have not been bad. I think 12, 13%.
Yes, Prashant sir, of course, there'll be most investors will have at least 1/3 of their money in equity, right? So now they will love to combine it by investing in balanced or hybrid funds with at least 1/3 in equity. So you're absolutely right. There'll be flight of capital inside mutual fund, but to different categories. And also the industry will also recalibrate their product offering. to make sure that this new inclusion of a third tax. Debt funds are only taxed two ways, equity or debt. And all the funds used to get categorized as these two. Now you have a third taxation. So I personally think the industry will recalibrate, an investor will recalibrate his investments. Most of them at least will have 1/3 in equity. So now they'll be compelled or forced to combine it both and use more hybrid products. Not that they need to change their asset allocation too much. They'll have to change their scheme selection more so. And so I completely concur with you that there'll be flight of capital from one category to another.
Feroze, I think we are not going to let you have an easy Friday. I'm sure one of us will reach out to get that math right. How to ensure that you're still making 8% even if this new regime comes in. So we'll keep you busy for sure even after the show. But, Mr. Singh, just want to come to you once again on the basic numbers. If you could just go over, of course, this is not retrospective, it's prospective. But what is the total quantum of AUM that's at stake? I mean, going into 1st April onwards, if you could just clarify that once. That and just how you see the next couple of days and weeks play out, and whether your corporate investors, whether they perhaps will have a relook as well. I mean, there was a comment from Mr. Sheshagiri Rao, for instance. This is not retail, we're talking corporate, and they were saying even we'll have to look at the way we are, parking money, managing our treasury, given this new tax regime, if it comes through.
Yeah, no, definitely what you're saying is right. But two things about this retrospective and prospective. I was just going through the document. Actually, document has written, I'm not sure, but I'm just going through the document 5 minutes back. It's written 1st April 2024. I don't know whether it is typo, and this is 1st April 2024 is written at 3 places. So this is wishful thinking though, but I think if it is from 1st April 2024, then we have some breathing time. That is number one. Number two, yes, definitely people will, there will be a slight flight, but see, till yesterday, we were saying, unfortunately, this category has not gone up very high. There's a scope of, it's going to be very, very big. Today, since the penetration is not very high, the impact will also be less. So that's the point, and the corporates will definitely look at them. But I think that there still will be a gap on the kind of yields which we will be generating, and the deposits will be having. There will be 150 basis points over the period of time. And taxation, as you said, as Chairman Mr. Khara said, taxation is not the only part. There are other things also which will play around, and I think mutual funds still will have a good enough niche to be serviced for the higher yields, where there will be risk reward, and I don't think there's going to be a very, very big impact in the time.
Right, Mr. Singh, you gave us some numbers earlier. Out of that 6.5 lakh crore AUM, what percentage is corporates?
I don't have the exact number, but it should be around 50%, more than 50% actually.
More than 50%. Bala, it would be the same for you as well?
Yeah, I think it'll be the range of about 60 to 70%, Prashant. And I think I think retail would be largely come in the one is the long-term funds, second is the hybrid funds. To the extent we can say the retail contribution at this point of time is still very large. But again, I come back to the old point, earlier point that I think from a larger interest point of view, asset allocation, if one looks at it, clearly fixed income play a very big role. And this is the time actually build retail, given the fact that India needs large pool of retail investors to be in the bond market side.
Indeed, investment decisions are based on your goals, the asset allocation that you require. Just one more quick question, Mr. Singh. In the total inflows, 50% comes from corporates. What about HNIs and ultra HNIs and retail? If you could also bifurcate that.
Yeah, I think ultra HNI will be around 20-25%, and the remaining will be retail. So yeah. Both are equal. And see, one more thing which I would like to add. See, earlier there were two categories only. It's either equity or debt. Now it will be debt category. It will be hybrid category with more than 35% up to 65%. And there will be an equity category which is more than 65%. So I think we'll have to tweak the products a bit, like the conservative hybrids, which are putting up to 25% in equities, may be made 35%. So that category will still be there. So there will be a tweaking in the categorization also in the new regime.
All right. We'll take a quick commercial break here. I have to do that, but we'll come back with all three of you. Stay with us and we continue this discussion. So many angles to this one. Stay with us.
Okay, so we're just trying to still go through the potential impact of these proposed amendments to the finance bill that could bring about a huge tax blow for debt mutual funds. Our panel of experts is still with us. Bala, I just want to go back and revisit the numbers because, there are a lot of moving parts to this. So first, tell us, for the industry as a whole, I mean, in your capacity as the head of AMFI, let's leave aside liquid funds because, nothing really changes over there. The big chunky category where whether it's retail or HNI or it's corporates, where people were parking money to lock in the 3-year indexation advantage. How much AUM are we talking about at an industry level and then at a Birla Sun Life level?
Yeah, I'll just talk about the industry level, Surabhi. Just take roughly about 12 lakh crore or 14 lakh crore is the fixed income size, out of which 5.5 to 6 lakh crore roughly is the liquid fund and liquid plus kind of funds, and rest of it coming from the debt funds that invest between 1 to 3 year maturities. So that's a large component. And within that, if you have to take a target maturity fund with the DP Singh mentioned about, the target maturity fund carries the two things. One, what industry has been doing, close to about now lakh of crores as size today. In addition to that, the government of India has been having the Bharat debt fund, which is now close to about another 77 crores, which essentially is the borrowing coming for 10-year period by PFC, REC, and various such government institutions. That category is about roughly about lakh of crores. I think both put together about 2 lakh crore and roughly about 5 lakh crores is actually the actually managed debt funds, the longer maturity and medium maturities. And liquid plus is about money market funds close to about 5 lakh crores. And within that, if one looks at it, we also invest, of course, close to about 16 lakh crore. Investment is made collectively by the industry into the various instruments issued by Indian corporates, NBFCs, government of India, and government-owned public sector institutions. Within that, I also looked at the one number. Greater than 3-year maturity, the industry has been investing close to about 4.2 lakh crore. 4.2 lakh crore is investment that is being invested by mutual fund industry into greater than 3-year bond, which essentially means that all the financing of the longer-term bonds are also being financed by the mutual fund. Where is the help? Definitely workers funding being made available for long-term investing. And second is they also get the pricing which is linked to the market. The price discovery is far superior. Therefore, come into the bond market for borrowing. And all these bonds are actually listed in the market as well. Who have been playing a larger role in this? The mutual fund playing a larger role in this. See, in that context, if one looks at it, I think clearly from the big picture point of view, definitely I think the large pool of retail investors who have been predominantly investing in equity in the last few years, and as well as, of course, the fixed income, there is a huge merit for them to be in the fixed income space, given the fact that it's a huge alternate asset class for them from their point of view, and risk reward is better. And times of volatile period, it also can act as a hedge.
Bala, again, just to drill down to the one big number that we need to watch out for, whether it's in target maturity funds, whether it is in, any other category. I'm just leaving liquid aside because typically investors in liquid funds are not looking to park money for a long time. You mentioned 4.5 lakh crores, and this could be retail, it could be corporate, it could be any category of investors. Is that the sum, which is 3 years plus maturity, and then therefore if money has to shift and look for better alternatives, then is that the quantum that we're talking about?
No, that of course, that quantum will be relatively less because in any case, if at the moment I move from liquid fund, liquid plus actually to the medium duration funds, roughly about 50 to 60% comes, as Feroze also mentioned about, they all come from the short-term capital and purposes. And on a relative basis, of course, they had a better tax adjustment they can make. That's one part, of course, is there. From a retail investor's point of view, a large pool of about 20-30% of the money would have come in that segment. To the extent the number, of course, will get further drilled down. I don't think we should look at it on a narrow basis. What is the amount that we have today? I think it's about future development, right? Anything that we do has to be intended with the future development. At this point of time, though, we can say the large pool of retail participation and HNI participation in mutual fixed income schemes is not very large. Therefore, the impact would be less. But I think that today the fact of the matter is what you're looking at actually is the future development of the market. I think one has to look at beyond what currently is there.
Bala, just one quick question. Since corporates were parking their money, they were raising money by investing in the debt mutual fund and financing their capex. Is there, one unintended consequences that their cost of capital now goes up, which starts hurting? Have you heard from any corporates? And would there be any representation that the industry will make to the government? And if yes, could you outline what would be the top 3 key points that you would make?
Yeah, definitely. I think it's too early to quickly react on this, given the fact that they'll have a lot of moving parts which drives the spreads and interest rates and so on and so forth. And the fact of the matter is, as I mentioned, the single number, close to about 4,20,000 crores being invested in the greater than 3-year bond issued by various corporates, which includes public sector financial institutions and various other corporates. The natural assuming scenario, there is a bit of drying of this pie of the money coming to the mutual fund. Naturally, it can actually push up the yields on the borrowers as well. Again, that will be depending upon how the liquidity will play out, how the RBI policy will play out, and so on and so forth. But the fact of the matter is, the moment that gets dried, naturally we could probably see that spread widening. Even the Bharat ETF, that bond ETF that government of India has been issuing, at this point of time, it gets subscribed very easily, given the fact that on a 10-year you get that indexation benefit long-term capital gains get. And now, assuming incremental they have to borrow, then actually have an impact. Now we want us to look at it, what is the tax benefit I get, vis-a-vis what I get in fixed deposit and so on and so forth. Therefore, we'll probably have a rethinking of investors coming into these funds, and to the extent it can only push up the yields further.
Okay, got that. Just one data point, if we can put this up on the screen. By the way, the individual investor allocation to debt has been coming down, right? In FY19, it was at 25%. It's been coming down ever since then. In FY22, it was at 15%. 9 months of this year, also, it's been at around 14%, whereas the institutional investor allocation has held pretty steady at around 34-35%. Mr. Singh, we've spoken about, the shift to perhaps hybrid, to a balanced advantage kind of category. How do you think this would play out if you were to look at, say, an arbitrage fund, if, you do have to move out of this space? Do you think money flows could increase in that category as well?
No, definitely. Arbitrage fund is always seen as an alternative to the liquid funds and ultra short-term funds. Nobody is putting money for more than 3 years in arbitrage funds because that is not required. That's an equity category. But just that can be used as tactical allocation in the fund like balanced advantage fund and the conservative hybrid fund. That is one. But the overall impact is the retailization of debt will definitely get impacted. Because this was a category where actually real return, this was the only category where we were able to talk about the real returns to the investor. Because if you talk about with the marginal rate of interest, on yield basis alone, it will be see negative returns only. As it is in the bank deposit, and the debt mutual funds also it will be there. But just as your question goes, the hybrid funds, the first category of hybrid fund that is conservative up to 35% and then going up to 65%, those categories will definitely get a boost and retailization will happen in that category now.
Just last, very briefly, Bala, this has come out like a missile, right, out of the blue. I don't think we discussed this much taxation on the day of the budget at all. So was there any consultation, any questions, any phone calls, asked, or is this just out of the blue?
Of course, Prashant, this came out of the blue and none of us expected. Even the budget day, when we deep dive into analyzing the budget provisions, and there is no mention about either indexation or the debt taxations. Therefore, in the final bill when it definitely came as a surprise. I would assume, of course, in the whole industry, my own experience so far has been not necessarily you go and make a representation. Some other industries coming from the same industry, financial market, they go and make a representation.
Bala, now you're talking. I didn't want to ask directly, but where? So
they all really where government also gets ideas. Somebody goes and make a representation saying whatever you are giving to others, please also give me. And government has got two choices. Either we give or you take it away.
So this is so people sitting a few floors below you, Bala, from the insurance side, I'm assuming.
Yeah, no, of course. It's banking industries, IBA. Sometimes we do joke actually which body is more powerful. And AMFI, of course, we as an industry keep doing a lot of things right from the retail investors' point of view. I'm sure we'll continue to play the bigger role of development of the capital market.
Mr. Singh, you would concur? You would concur broadly? Because the feedback we are getting is that life insurers, there is that one disappointment that there is no rollback to what was announced in the budget, that 5 lakh thing. But otherwise, there is general happiness in the life insurance industry.
Yeah. No, honestly speaking, I don't want to talk about it because, see, I don't know. Because when you don't know anything, then you keep on guessing. So I really don't know what was behind the curtain. But one thing is there, it has definitely come out it's out of blue, definitely. But this one vehicle which was there, that will get impacted. But as Mr. Kara said, it's the overall economic condition of the country wherein all the players grow. And I'm sure the kind of growth which is happening in the country will continue to grow in spite of. See, these things will keep on happening. So many disruptions have happened earlier also. But we are sure that as industry will continue to grow in a big way.
Those are brave words, Mr. Singh, and we wish you gentlemen the very best of luck. You know, Prashant and I were joking in the break. It's a Friday. Who from the SBI house is going to be a happier, more relaxed gentleman today, Mr. Khara or Mr. Singh? And I think we'll have the answers by the time the day ends, right? So, thank you very much for joining in. We live in very interesting times. Let's see what the government's thought process is with respect to changing taxation that influences the way we manage and invest our money. Thank you very much for joining in with your comprehensive take on the way things stand as of now. We'll take a break on that note. On the other side, we put the spotlight on the life insurance space on the back of the finance bill's proposed amendments.